First chapter is the conceptual and case analysis framework for the financial reporting. So it's very kind of narrative chapter, if I can say that, which is explanational by international financial reporting standards and focusing on the particular part of the financial reporting standard, which is the first part and more specifically conceptual framework. Why this conceptual framework is so important for financial reporting? Because if there's something that we can call Bible in the financial reporting, the conceptual framework will be the Bible. This is the foundation on where everything, all the concepts in the accountings are actually discussed. So the financial statements obviously should carry the needs of the users. So we have to identify which the users of the financial statements are, what they want to see. Now, who administered this conceptual framework? That conceptual framework is administered by International Financial Accounting Standard Board and is adopted in Canada and Chartered Professional Accounting Canada Handbook has that conceptual framework as well. So this handbook is a document in Canada because many legal statutes require to use it, mostly accountants, and provide accounting and reporting requirements at the same time explanation and guidance how to record the transactions, how to treat events, how to identify which is the element of the balance sheet, which one is the element of the income statement, which one is the element of what. Then when the transaction event is not explicitly addressed by these standards, then we have to take a look at the conceptual framework on the financial reporting. Now, the conceptual framework, the purpose of is to assist the International Accounting Standard Board to make sure that all the concepts are the same across the globe, assist the preparer to develop consistent accounting policy when there's no standard applied for that particular transaction, and assist all the parties to understand and interpret the standards. Then conceptual framework is not a standard. Nothing in the conceptual framework overrides any standards or any requirements in the standards. Conceptual framework has a primary emphasis on the properly recognition and reporting of the assets, liability, and other elements, which is income, expenses, and equity. All the accounting practices should be traceable to and supported by the conceptual framework. And in conceptual framework, as we can see in a few minutes, we have different chapters. First chapter is the objective. Second one is the qualitative characteristics. Third chapter is financial statements and reporting entity. Chapter 4, element of financial statement recognition. Chapter 5, measurements. Chapter 6, presentation disclosure. Chapter 7, and Chapter 8 is the concept of the capital and capital maintenance. And that will be it. The first time when you have faced the conceptual framework was when you start your journey to the intermediate financial reporting standards. So that will be course 331, I believe, for you. That will be intermediate financial reporting 1. And then in the first 2 chapters, the teacher usually talks about the conceptual framework and explain the different elements of the conceptual framework. Assuming that you, for some reason, something went wrong, so this is a good kind of time to refresh ourselves on the conceptual framework. Now, the professional judgment is always needed. So what will be the professional judgment? The professional judgment will be your ability to make a decision in a situation where the answer is not clear. So what's the professional judgment? When you have to express your professional judgment, it's every time when you have to make a decision in the situation when the answer is not clear. There's a lot of judgment involved when you have to prepare financial statements. You already know, and you'll be the judge. So there's a judgment involved in when you're accepting and adopting accounting policy, when you're making estimates, when you're writing notes to financial statements. But you have to keep in mind the financial statement should present what really happened during the period in the company. So in Canada, standards are you have 4 parts. First part is related to the publicly accountable enterprises, which applies international financial reporting standards. As I said, international financial reporting standards are adopted in Canada. Second part 2 is the private enterprises, which apply accounting standard for the private enterprises, which means you have to equally know both set of standards. Then we're going for the non-for-profit organizations. Non-for-profit organizations have a separate set of standards, as we're going to see in chapter 12. And pension plan, since the pension plan is publicly accountable enterprises, they also have a separate set of standards. Now, obviously, what happened with the standards in Canada? Canada, a long time ago, they decided they were thinking to go with the US, maybe because they said that Donald Trump is going to become a president and going to become a Canada part of US. I don't know. But they were thinking to go that direction. After that, they decided not to. And now for the most Canadian public enterprise have to report on the International Financial Reporting Standards, unless they're listed in US Stock Exchange, in which case they have to apply US standards. Part 1 of Canadian Handbook dealing with the International Financial Reporting Standards, as I said. And those discussions start a long time ago, 1970. Well, I guess my parents just become acquainted to each other on that year. I wasn't even born in that year, but in that year they decide to discussion between in Canada about gaps, big gaps, little gaps. What's the big gaps? What's the second gap? Until the 2006. When in 2006, Canada finally accepted international financial reporting standards. That reminds me the time that was very interesting. I came here in Canada 2003. Back in Europe, on that time, we were using international financial reporting standards. In Canada, they weren't using the international financial reporting standards. So I'm familiar with the international financial reporting standards. Nobody here in Canada knows international financial reporting standards. So I'm applying for the job and they're asking me, what kind of standards you're using to prepare financial statements? International financial reporting standards. And they say, oh, we're not using those ones. I mean, so don't worry, nobody's perfect. Eventually, you're going to start using them. Or why don't you hire me? I can easily help you with that. But they say, no, we need somebody with Canadian experience who doesn't know international financial reporting standards. Anyhow, that was interesting, very interesting. But anyway, 2006, January 1st, those came in Canada finally. In 2009, it was decided that the private companies, they don't have to use any more international financial reporting standards. There was a new set created, which is part 2, and 2009 was introduced accounting standard for the private enterprises. And the private enterprises obviously can choose to use international financial reporting standards or accounting standard for the private enterprises. Why somebody is going to go when it's a private company to go to international financial reporting standards, which are more complicated? That's because if that company wants to go public in the next 2 years, for comparative purposes, they have to use it. Now, that is the choice. The key differences. So now, Pay attention, please, for these slides, because I saw on the CFE exam, question on one of the cases, the question was the owner of the company choosing that, wondering which set of standards to use, international financial reporting standards or accounting standard for the private enterprise, and he asked you to explain the differences between those. Right? So the key differences are, first, disclosure requirements. In the international financial reporting standards, very heavy disclosure requirements. Impaired loan receivable. There are different treatments under those two standards. Qualitative characteristics. That's from conceptual framework. Revaluation and depreciation of component of the property, plant, and equipment in the international financial reporting standard, accounting standard for the private. Impairment losses and subsequent reversal on the loss. Next one is the development cost. And we keep going. Post-employment benefits, different treatment. Accrual on the gain and losses. Income taxes. In the international financial reporting standards, we have deferred income tax component on the accounting standard for the private enterprises. You can choose the tax approach, so you don't have any differences between the taxable income and accounting income. Interest capitalization on the borrowing. Compound financial instruments. Preferred shares in tax planning. Value of the conversion option for convertible bonds. How we evaluating the value of the conversion option of convertible bonds if we have. Obviously, the small companies, they're never going to issue convertible bonds, because first, they're not going to issue bonds, and second, they're not going to issue convertible bonds, because having more shares, converting the bonds into the shares, not going to give any value to the creditors. Why? Because the company is private company. I cannot sell those shares on the market because there's no market. Lease accounting for the leasee, by the leasee. Lease accounting, that's a huge difference in the, as you remember, in the international financial reporting standards last semester, Alexander, we learned that there in the we have rights of use assets, where in the accounting standard for the private enterprises we have operating lease and financing lease. So you have to know those differences at least. So you don't have to know all the differences, but in the CPA reality, 3-4 of those differences should have come naturally for you. Lease is the one should come first. Interest capitalization, deferred income taxes, accrue on the gain and losses, post-employment benefits, disclosure notes. Those should be easily coming to you. Now, then we're moving to the non-for-profit organization. And again, we're going to see in chapter 12 how exactly we're going to deal with the non-for-profit organization and what kind of sets of standards they're using and what's the idea in those standards. Again, they're publicly accountable. And since the donors, they want to know where their money go, somebody has to review those ones. They have to apply some standards there. Now, all level of the government obviously should use this section, which is the section for the non-for-profit organization, and government business enterprises. Now, what if you have a government business enterprises? Government example for the government business enterprise will be ICBC. They have to follow the international financial reporting standards. Other government organization can follow either international financial reporting standards or public standards for the accountable enterprises. Now this is the type of organization and which standards they have to follow. That's on one page. You can see which one they're following and how they're following it. Now, analysis and the interpretation of financial statements. Now, we're going to come to the main objective of the financial reporting is to provide information which is useful to the external users. You have to understand, we're not preparing the statements. Financial statements are not prepared for anyone inside the company. The fact that the owner of the company is currently employed by the company, it doesn't make him an internal user. He's still external user because he is the investor. Now, what should be the quality of the financial reporting? That will be based on the accurately the financial statement present the actual situation of the reporting entity. And when the quality of the financial reporting is low, that means the user not being taught all the facts which are related to the transaction that happened in the company. Financial statement analysis. Now, once we have to do in the first assignment here, you have to do financial statement analysis. And the financial statement analysis is there are two approaches here. You have to do horizontal or vertical analysis. Horizontal analysis when you have a few years. And then in the horizontal analysis, as you can see in your assignment, you're gonna one of the year you're gonna choose as a basis year, so that means that 100%, and then you start comparing what's the next based on the compared to the base year, and that's how you're doing the horizontal analysis. The other thing is in order you to evaluate different entities, different size, and different industry, is you to move to the common size financial statements. What's the common size financial statements? Is the financial statement which is expressed by percentages, not by numbers. You cannot compare Rogers with local grocery store based on the dollar amount, because that's not going to make sense. But you can compare Rogers with the local grocery stores based on the percentage. What will be that comparison? Well, tell me how much is your gross margin in Rogers versus the gross margins in the local store. And then you can make a comparison. You can compare profitability of the Rogers and the local grocery store based on the net income divided by the total sales. Those one you can do, but again, you have to move to the common size financial statements. So when the company in the same industry using the different accounting policy, obviously it will be very hard to compare because now you're not comparing apple to apple. Then you might have to adjust the financial statement, one of the companies, to make the statement more comparable. Now, so there's on the financial statement analysis, you have horizontal, vertical, and ratio analysis. On the ratio analysis, you have 4 types of ratios: liquidity, solvency, profitability, and the last one was, I believe, is activity. So on the liquidity, since we are external, don't forget where we are. We're external users here. That means we are either investors, either creditors. We're going to check current ratio, definitely. Then we're going to check debt to equity ratio, return on the assets, and return on equity. Why? Because if I want to invest in this company, obviously my money is going to be the assets. Now the question is, how much this company currently generating from the assets that they have? Because if I add more assets and their earnings go down, that means they're not efficient of using the assets. They're just using the assets to feed themselves and to pay their liability. They're not generating anything from the operations. Don't forget, operations is the one that is on the income statement. So if the company don't have ability to generate income or cash from the operating activities, and you investing in that kind of company or you borrowing the money, you're in trouble. Why? Because the company is already in trouble. So for that reason, you have to watch for those current ratio, debt to equity ratio, return on assets, and return on equity. So at this point, I want to show you the conceptual framework, because I will assume that you never see this document before. And if you have seen it, and if the teacher on the intermediate financial reporting one already showed you that one, I would like to be excused for the statement that I made, but I will assume that you haven't seen it before. So for that reason, I want to show you this, and we can go over this because it's a very interesting. Again, if there is a Bible of accounting, that will be called from conceptual framework. Let me share my screen now with the conceptual framework. And that's conceptual framework. You can download it from the International Financial Reporting sets that I already posted for you in Moodle. So you have all those standards, including the conceptual framework. So let's go here. I'm going to increase the screen, my screen a little bit. And can you guys see my screen?
Yes.
Yes.
Okay.
Yep.
Very briefly here, we're going to go, again, the chapters that we already saw on the slides. Chapter 1 is the objectives of the general purpose financial statements. Then chapter 2, qualitative characteristics, usefulness of financial statements. Chapter 3, financial statement and the reporting entity. Chapter 4, elements of financial statements with the definitions. What's the definition of assets? What's the definition of liability? What's the asset and liabilities? What they present? What's the definition of equity? We're going to see those definitions. So then we're going to have recognition and derecognition criteria. What's the recognition criteria? What's the derecognition criteria? How are we going to measure it? We're going to see that there's a historical cost, there's a current value. That's for the measurement basis. Information provided for particular measurement basis. Again, we're going to see all those different. Then we're going to have a presentation and disclosure in chapter 7. Then we go in chapter 8, which is concept of the capital and capital maintenance. It's very, very interesting reading. At least for me, it's very interesting reading. It should become a very interesting reading for you as well, if you want to continue with the accounting. Because again, now when you go through the accounting courses, you're gonna have a different look, and you're gonna see different things when you start reading this. Why do we need this one though? The purpose of the conceptual framework is to assist international to develop standards that are based on the consistent concept, and assist preparers to develop consistent accounting policy when no standards apply to a particular transaction or other event, or when the standards allow the choice of the accounting policy. Also going to assist all the parties to understand and interpret the standards. So now, as the slides say, so if you're wondering from where this information on the slides comes, it's from the International Financial Reporting Standards. So basically, what we're looking here is we're not looking the slides here. We're looking for the source of the slides. The slides are based on the International Financial Reporting Standards. By looking at the slides, you're looking at the secondary document. By looking at the document which is issued by International Financial Reporting Standards, or this particular document, that means you're drinking water directly from the mountain, directly from the creek. There's no more accurate and there's no more pure information than the information which is sitting here on the conceptual framework. So this is the explanation of the conceptual framework. Again, let's go with chapter 1. Now, objective for what's the objective for general purpose financial reporting forms? The objective of general purpose financial reporting forms the foundation of the conceptual framework. Other aspects of the conceptual framework, the qualitative characteristics, and the cost constraints on the useful financial information, a reporting entity concept, element financial statements, and so forth, and so forth, and so forth. Now, objective is, or general purpose financial, is to provide. Why objective of purpose financial reporting? Why do we have to do financial reporting? Is to provide financial information about the reporting entity that's useful to existing and potential investors, lenders, other creditors in making decisions in relation to providing resources to the entity. This is the objective of general purpose financial reporting. Nothing more, nothing less. To provide, again, financial information about the reporting entity that is useful to the existing and the potential investors first, lenders second, third, other creditors, to make decisions relating to providing more resources in the entity. Which are those decisions? Now, those decisions about buying, selling, holding equity if you are investor, or debt instruments if you are a lender, providing or setting the loans and other forms of credit if you are other creditors, exercising rights to vote, investors, or otherwise influence the management action that affect the use of entity economic resources. That one's the first one that I wanted to see. Now let's go to the conceptual framework. Knowing many existing and potential investors, lenders, and other creditors cannot require reporting entity to provide information directly to them and must rely on general purpose financial reports for much of the information they needed. So consequently, they are the primary users. However, this is interesting. However, the general purpose financial reports do not and cannot provide all the information that existing potential investors, lenders, and other creditors need. These users need to consider permanent information from their sources, from other sources, for example, general economic conditions or expectation, political events, political climate, culture, industry, company outlooks. So that's another interesting thing here. Watch this. The general purpose financial reports are not designed to show the value of the reporting entity. But they can provide information to help the existing potential investors, lenders, other creditors to estimate the value of the reporting entity. So in other words, you don't have to tell them what's the value of the entity by producing the general purpose financial reporting statements. That's not the objective here. If they don't know how to do it, that's not our problem. And what you have to understand is the individual primary users have different and possibly conflicting information needs and desires. So the other interesting thing that I wanted to do is the economic resources and claims. There's a changes in economic resources and claims, financial performance. That's the interesting part here. Let's move to the chapter 2, which is qualitative characteristics. Which qualitative characteristics probably you already know from chapter 2 in the intermediate financial reporting 1. But if you haven't done it, let's see what means qualitative characteristic? Qualitative is characteristic is useful financial information, discuss, identify the type of information that likely to be most useful to the existing potential investors, lenders, and other creditors. As you can see here, we're always going to repeat, they're always going to repeat useful to the, this one always going to repeat existing potential investors, lenders, other creditors. So which are those? First one, we have two types. We have fundamental characteristics and we have enhancing qualitative characteristics. So let's see which are the fundamental. Fundamental characteristics are relevance and faithful presentations. Relevance, what's a relevance? Relevant financial information is capable of making a difference in the decision. Financial information is capable of making a difference. What's the relevance here? What I'm looking for is definition for the relevance. In the decision making, the financial information is capable of making difference in the decision if it has predictive value, confirmatory value, or both. Financial information has predictive value, so this is explanation what's the predictive value, and this is information what's the confirmatory value in order to be relevant. Next thing is to be materiality is also discussed here. Information is material if omitting, misstating, or obstructing it could be reasonably expected to influence decision that the primary user of general purpose financial reports make on the basis of their reports which provide financial information about the specific reporting entity. In other words, materiality is entity-specific aspect of relevance based on the nature or the magnitude, or both, of the item to which the information relates in the context of the individual entity financial reports. Consequently, the board cannot specify a uniform qualitative threshold for the materiality. So who's going to provide the materiality? You. Why? Because you're the one who has to use the judgment. Why? Because that answer here for this situation is not clearly provided to you. So you have to come up with the materiality. Then we're going to the faithful presentation. What means faithful presentation? To be perfectly faithful to this presentation, a depiction would have three characteristics. It will be complete first. In order to be faithful, it has to have three characteristics: complete, neutral, and free of errors. And then we're going to have what's the neutral depiction. Neutrality is supported by exercise and prudence and everything like this. Existence. What's existence? And the last one was what was the last one? The last one was depiction and free of errors. And there's explanation for the free of errors as well. Next, we're doing applying the fundamental characteristics when we're going to apply those one, and what's going to happen when we apply those one. And then we're going to the enhancing characteristics. So now, once we have the fundamental characteristics, which are implied when you're preparing financial statements for the potential and existing potential lenders, what was that? Investors, lenders, other creditors. Then we're going to put some enhancing qualitative characteristics, which are comparability, verifiability, timeliness, and understandability. And then we're going to start looking at definition of each of those. Comparability. Comparativity is qualitative characteristics that enable users to identify and understand similarities in and differences among items. Unlike any other characteristics, comparability does not relate to a single item. A comparison requires at least two items. So you cannot compare net income with the net income on the same year. You need at least two items. Consistency, allowing although related to comparability, is not the same. Consistency refers to the use of the same method for the same items, either from the period to period within the reporting entity or in a single period across entities. Verifiability, what helps, can be and helps the user to that information faithfully represents the economic phenomena it purpose to represent. Verifiability means that the different knowledgeable and understandable observers could reach consensus, although not necessarily complete agreement. So they don't have to completely agree, but they have to reach some level of consensus that a particular depiction in the faithful presentation. And that will be direct and indirect, and explanation of direct and indirect. Timeliness. What's the timeliness? Timeliness means having information available to the decision makers in time to be capable to influencing their decision. What's the time? Again, it's very subjective. Generally, the older the information is, less useful is. However, some information may continue to be timely long after the end of the reporting period because, for example, some users may need to identify and assess trends. Now, the one thing that I love the most is the understandability. In order to see the beauty of this, I want you to your attention here and just stay with me here. Classifying characteristics, classifying, characterizing, and presenting information clearly or conclusively make it understandable. Some phenomena are inherently complex and cannot be made easily to understand. Excluding information about those phenomena from financial reports might make the information in those financial reports easy to understand. However, those reports would be incomplete and therefore possibly misleading. Financial reports are prepared. So pay attention here, 236. I want you to understand to whom we prepare the financial reports. Financial reports are prepared for users who have a reasonable knowledge of business and economic activities and who review and analyze information diligently. At times, even well-informed and diligent users may need to seek the aid of an advisor to understand information about the complex economic phenomena. So, that being said, if the person who's using financial reports have no understanding about accounting, that's not our problem. If the person whom using the financial reports make a decision based on the weather, and after that he losing money because he don't understand financial statements, not our problem. We're talking here about the user who have a reasonable knowledge of business economic activities and who review and analyze the information diligently. And even they do that, sometimes they might need or seek aid for the advisor. So what's next here? Once we follow those enhancing characteristics, we're going to go to the financial statements and the reporting entity. And here we're going to see which are the financial, what's the first objective and scope of the financial statements. Objectives financial statement to provide the financial information about the reporting entities' assets, liabilities, equity, income, and expenses that is useful to user of the financial statements in assessing the prospects for future net cash inflow to the reporting entity and in assessing management stewardship of the entity economic resources. And information is provided in the statement of financial positions, which is the first one, which recognizing asset, liability, equity, statement of financial performance, income, expenses, other statements, asset, liability, cash flow, contribution from the shareholders, method assumptions, and everything that you can think about it. What's the reporting period? Explain the reporting period. What's the prospects adopted in financial statements? Going concern assumption is also treated here. And then what's the reporting entity? The reporting entity is entity that is required or chooses to prepare financial statements. Can be single entity, can be portion of the entity, can be comprised from more than one entity. Then we're going to the elements of the financial statements. So that's very interesting here. The element of financial statement defined conceptually are asset, liability, equity, income, expenses. And here you're going to see element, asset, what's the asset? Liability, what's the liability? Equity, what's the equity? We have economic resources, we have a claim. Then we're going to have changes in economic resources, other changes in economic resources. And then we're going to go definition of the assets. Is a present economic resource controlled by the entity as a result of the past events. Then we're going to the definition, what's the rights? Here, this section discusses three aspects of those definitions. Rights, potential to produce economic benefits, and control. And rights, what's the rights? And then we're going to have potential produce economic benefits, what that means, and the last one is control, what that means. Then we're going to the liability, definition of the liability. Liability is a present obligation of the entity to transfer economic resources as a result of the past events. The only thing that's missing is to transfer to obligation to the entity to transfer economic resources in the future as a result of the past events, but it's indirectly implied that it has to transfer the resources. And again, we have here liability exists, three criteria must be satisfied. Entity has obligation to transfer the economic resources, and the present obligation that exists as a result of the past events. So we start with the obligation first, and then transfer the economic resources. What's the economic resources? And then the present obligations is of past events. It's explaining those ones. And then we're going to the asset and liabilities or unit of account. And then we're going to the executory contracts. Where is the equity? I'm looking for the equity here. Definition of equity. Equity is the residual interest in the assets of the entity after deducting its liability. So basing from the accounting equation, equity is asset minus liability. End of the story. Nothing more, nothing less. And then it's different discussion about the equity, income and expenses. What's the income? Increasing in the assets or decreasing in liability does result from the increase in equity other than those related to the contributions from the holders of the equity claims. And expenses, what's the expenses? And then we're going to the recognition. That's a very important first, because the element can meet the element of the financial, transaction can meet the element of financial statements, but we cannot recognize it. Then we cannot record it. And here, dealing with the recognition, the process of capturing the inclusion in the financial statement of the statement of the financial position or the statement of financial performance in the item that meets the definition of the one of the elements. And we're going to the idea that here this how recognition links the element to financial statements. First, asset minus liability equal equity plus income minus expenses, changes in equity, plus contribution from the holders. Assets minus liability equal to equity. So everything that we're teaching in those courses is basically already communicated to you in the conceptual framework. The only thing is that's why the start of the international intermediate financial reporting starts with the conceptual framework. But now we finish it with the conceptual framework, so you can see everything on one place. And we can keep going, but I want you to one more thing that how we're gonna measure it. So because first, once we find it exists, then we have to measure it. Elements recognized in financial statements are qualified in the monetary terms. This requires the selection of the measurement basis. Measurement basis in the identified future, for example, historical cost, fair value, fulfillment value, or item being measured. What's the measure base? And then we're going to historical cost, and what's the historical cost? And then we're going to the current value. What's the current value? Now the current value includes, it's not limited only to current value, but includes fair value, value in use, current cost, and then explanation. What's the fair value? What's the value in use? What's the current cost? And keep going. As you can see, very interesting. And here you have a chart, summary information provided particular measurement basis. What's the carry amount? For the carry amount, which one of those applies? And that's with conceptual framework, enough with the conceptual framework. But I believe you get the idea what's happening here. I would strongly suggest you to go at least one over the conceptual framework. Don't read too much, don't get too punctual here, but at least get the idea what's important, so you can understand the process of recognizing the element of the financial statements, measuring that element of financial statements, reporting and recording that element of the financial statements. Because it's one thing is to record it, the other thing is to report it. And I want you to understand those things, please. It's important for me, to know that you know how to do those things. So now let's continue with the slides at this point. The slides at this point continue with the case analysis. Now the case analysis, that's a very interesting thing, but in the case analysis, if I want, I'm gonna share a document with you, which is gonna help you with the cases. We're not gonna have a chance to go with the cases, but I can show you one or two cases here at the end of the class, at the end of this course, so you can have some ideas about the cases. And if you want to practice cases, you can start practicing cases. But that will be for your benefits outside of the scope of this course. So obviously we have to go through so many things. First, we have to identify who you are, what's the requirements, who are the users, what the user need, what's the case environment, what's the issue, which one is the highest issue, which one is the lower issue, from which issue you have to start first. Is this issue related to the financial, which of the technical competencies which are tested in the international financial, in the CPA world? And then keep going to find the alternatives. Once we find alternatives, we have to come up with the conclusion and recommendation. And then we have to communicate everything in form of the report. That's the whole thing. The only thing is that we have to go through this. You have to be able to go through this in the super fast speed. By the time you're reading the case, And by the end of finishing the reading, you have to have answers of all those questions. Your role, what's the requirements, what's the environment, what do I know about the environment, how can I focus, what's the level of the users. You have to rank which one is the most important issue, which one is the second important issue, how to rank those issues. By the time you finish reading the case, you have to have those answers. I know when you go to the CPA, they're going to tell you, do outline, and based on the outline, prepare your answers, blah, 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 blah. Thank you very much. Waste of time. If you ask me, that's waste of time. But since you're not going to ask me and you're going to follow in CPA, that's fine with me. The one thing that I have to tell you, whatever CPA tells you about marking is perspective of the people that never mark cases. It's a conceptual framework which CPA have and delivering to the students, but that's not how the cases are marked. Sadly, but that's the truth. Why I become a teacher? I'm going to tell you why I become a teacher. Because I was a marker. I was marking cases. I never was teaching in my life before I start teaching in Accent 2014. I start marking cases 2000 and I don't know which one actually was 2008, 2009, something like that. Start marking cases. First, I start with the marker, then I become a special marker, which is help the senior marker to mark, then become a senior marker. So basically, I have a team with 7, 8 people, depends on the size of the exam, which I have to teach them. Then I have to control them, and then have to monitor them how they mark the cases, which is the marking session, which on that time was like a 1 week. I have to do the audit, I have to do their performances, they have to check every day, I have to remind them every day what to do, what they look for, what they're not looking for, how to mark, on which case, what will be the marks they're going to give us, everything. And at some point, by reading, because I'm also marking the cases, don't get me wrong, I'm monitoring my team and teach them how to mark, but also I'm also marking the cases. And sometimes I'm seeing the students writing 2, 3, 4 booklets on the case, and they cannot pass because there's nothing there. It's just gibberish. It's just writing, which is useless. And I'm start thinking, what's wrong with these students? Why are they doing that? So what I did is I went to the classroom without telling obviously the person who's taking the sessions, that to see what they actually tell them. And everything that those instructors telling them how the case is going to be marked was totally wrong. Why? Because I'm the one who telling how to be marked. And I know that, and let's say 50% of what the person says on the stage is totally incorrect. And if the students follow his directions, they're never going to pass. That's what I'm telling you. You're going to go to the CPA, and probably you're going to forget my words right now, but I'm telling you, whatever they tell you, you have to understand 50% is not correct. They're going to throw you in the direction which is going to waste your time, they're going to make you frustrated, and the chances you to pass are not very high. That's the reality. So that's why I become a teacher, so I can teach my students how to pass the exams. So yes, all those things are important. We're going to go over the case. I'm going to show you what's important, how to read the case, and how to extract the information, which information is going to help you to extract all the requirements, to address it by level, by technical competencies, which one to solve first, what's the level of the answer that you have to reach in order to get a pass, and everything. And obviously, you have to communicate this in form of report or in form of email or anything like that. So now on the CPA exams, the only time that you have to write a report, format of report, and you have to use the format of report is day one. And that will be capstone 1 and day 1 exam. In any other cases, day 2, day 3, and all the PEP courses that you have to go through, capstone 1, capstone 2, no, core 1, core 2, elective 1, elective 2, you don't have to write report. Even if the case seems like you're asking for the report, there's no requirements for the report. The highest one that I see is draft a report, which draft a report doesn't mean that you have to prepare a report. So it's always going to be in form of memo. That's your chapter 1.